Why would anybody use hard money when they could go to a bank? We do all of our draws through SiteWire, which is a virtual construction inspection. So you literally say, and the way it works is you take a picture, 10 windows are in, the budget says 10 grand, we fund. We don't ask for invoices. If there's 7 in, we fund 7 grand. So it's always the work has to be done, installed, and then we reimburse you for the work complete. So that's a liquidity factor that you have to know. Question. We do. So our 2 conditions, well, 3 on a borrower are going to be the minimum credit score, 660, verifying experience, and then liquidity. And liquidity is relative to the deal size. So you could be buying $1 million property, a $2 million property, or a $200,000 property. It's all going to depend on how the economics look, but generally, we're going to want to make sure that you have the down payment, closing costs, and then a little working capital to be able to buy windows, get them installed, and then be reimbursed. And it's usually on a regular standard flip, it might be 25 grand above and beyond what you bring to close. The calculation is really 5% of the initial advance plus 10% of the budget. There's no minimum, this is how many interest payments you'll be able to make with it, but there is a working capital delta that would be part of your personal conditions to get a loan from us. It's more common sense though, because if you don't have extra money to go buy windows and get them installed, well, you're sitting there with this idle project that you can't move forward on. So we want to make sure you're successful. We have the money set aside, but I want you to think about it like we're a lender, right? So we want to lend into added value, and that's what you're doing. You're adding value to the property. We keep lending against that value every time you add more. So that protects us because unfortunately, things happen, borrowers run out of money, and then projects fail, and we have to step in and make sure that the project gets funded, and that's why the money is put into construction, to make sure that you have the money and that we also are fully capitalizing the deal. And then we can talk about it. I have the last part of what would be the BRRRR strategy, buy, renovate, rent, refinance, rinse, repeat. And at the end of the day, DSCR programs are also much like a hard money in the sense that it's we're lending to an entity where we're isolating you personally and from the investment, but it's more invasive or more paperwork because we're going to be looking more at the leases and making sure that you're not occupying the property, make sure your tenants aren't relatives and the rents are there, because that ultimately is how you're going to pay the loan, is to use the income from the rents, less taxes, insurance to cover the debt service payment. So the BRRRR strategy, so we have that program, and that's a good complement. So the basic requirements of a hard money is going to be that it's not owner occupied. For us, it's going to be residential, multifamily. We're pure residential guys. There are hard money lenders out there for every segment and for commercial and whatever. You'll find them, and that's the best part. Again, it's a really big industry, and if it's real estate and somebody can put a first mortgage on it, you'll find somebody out there that might lend on it. All loans must be done in an LLC or corporation. Again, that's to separate us and to insulate us from being a consumer lender. We can't lend to a consumer. I think the state of Massachusetts, don't quote me, allows you to lend to a consumer 5 times before you can lend and it becomes predatory lending, because our rates are high. Now in Massachusetts, there's no usury. You can put whatever rate on it you want. I've seen people charge 22%. But at the end of the day, you got to be aware of how the whole thing is structured. It's hard to get into, but I'll continue to go through different elements of this program, and we'll talk more about it. And then more experience to better terms. We talked about it. Post-closing liquidity of approximately 10%. We talked about that. And then the overall theme of our underwriting is we're not going to pull your credit. We're not going to do anything. We're not going to charge you an application fee. I'm not even going to ask for an application, quite honestly. But we trust all the information. We get you fully approved, term sheets issued. And then once it's in processing, then we pull credit. Then we want to verify your experience. Then we ask for a bank statement to show liquidity. It's very easy to go through our process up front, because it has to be, because we have to move quickly to get these deals closed. Scaling with hard money. Speed equals volume. We're closing in under 2 weeks. You can stack projects back to back. I have one borrower right now closing on 4 properties under one loan. I've got one borrower building 4 properties under one loan. I've got borrowers that are coming to me back to back. I've got at least one person with 4 different properties, 4 different loans in the pipeline with me. So you can do different things. We can lend up to 10 million but it's countless projects. So no borrower caps. Experience pays. We talked about the experience being what we focus on most in the private lending space. And then, you're preserving capital. So with hard money, right, if we can lend 90% of the purchase plus 100% of construction, and then with the experience, all the interest payments, our leverage is 92 to 95%, depending. So it's a little bit, it's more of a, pro tip, but look at your cost of capital and your capital stack and say, if my equity, I'm able to get 25% returns on my money and I can go pay ABL 9.5%, well, then you could do more deals. I have to buy a property cash to close in 2 weeks, or I can use hard money, or just the simple analysis of why would anybody use hard money when they could go to a bank? Well, 7% money versus 9.5 isn't that much when you have to put more money in, deal with all of that nonsense. So if you price your capital stack and you say, my equity is worth 25%, I wouldn't invest in anything for less. Well, then that's 25% money. So if we're lending all the way up to 95% and it's at fixed cost, it's not investor capital, you're not borrowing it from a guy or a gal that's asking for 25% of the profits on top of this or that, and maybe wants to make decisions. No, we're a fixed cost of capital. We're lending 95% of the capital stack. And if you model it all out, it might save you ultimately, it might save you in what I would call borrowing costs. Your total cost of capital matters.